Right, Betterment. New series. Let's crack it open.
For 3 years, a robo-advisor told clients its tax loss harvesting system was working. It had coding bugs that stopped it from working for roughly 25,000 accounts, 4 million in missed tax benefits. The regulator settled for 9 million. Median payout to affected clients was roughly 100. Then a client had 300,000 frozen for 3 months after submitting identification the company's own policy said should take 3 days to review. Another client requested a partial transfer, and the system liquidated their entire portfolio because the request exceeded 90% of the account value. That policy was not prominently disclosed. 18 years of operation, over 45 billion in assets. The automation thesis built during the worst financial crisis in 80 years. The question is whether you are paying for the algorithm or for the promise that it works. Founder graduated from business school in 2008, the same year as the financial crisis. His background included time at an investment bank and at technology startups. What he saw in both environments was the same problem. Human financial advisors had conflicts of interest, high minimums, and behavioral biases. Retail investors, who managed their own portfolios, made systematically worse decisions than a simple passive strategy would produce. The thesis was to automate everything: invest automatically in low-cost index funds, rebalance automatically when allocations drift, harvest tax losses automatically when markets fall, eliminate human advisor conflicts through algorithmic transparency. The product launched publicly at a major technology conference in 2010. The timing resonated. The humans had just failed everyone spectacularly. The algorithm would not. Growth was rapid. Multiple funding rounds followed. The company became the largest independent robo-advisor by customer count. Peak valuation reached $6.25 billion in 2021 after raising roughly $435 million in total venture capital. In December 2020, the founder stepped down as chief executive and moved to chairman. The official reason was personal. The replacement was a former chief operating officer from a media conglomerate. Her background was in entertainment operations, not financial technology. Her leadership focused on operational scaling, growing the cash product, and achieving profitability rather than product innovation. The company reached profitability in 2024, but the core product that justified every fee it charged had already been broken for 3 years before anyone outside the company knew about it. Tax loss harvesting works by selling positions that show a loss to generate a tax deduction, then immediately repurchasing equivalent securities to maintain market exposure. The algorithm is supposed to monitor portfolios daily. When it works, the company claims roughly 1.1% annual tax savings on average. The fee is 0.25%. If the harvesting delivers, the net benefit to the client is roughly 0.85% annually on a taxable account. That is the entire fee justification. Between January 2016 and April 2019, coding bugs prevented the system from executing correctly for a subset of accounts. The algorithm was supposed to run daily. For affected accounts, it was not running at all or was not completing correctly. The company told clients it was working. The regulator found otherwise. Betterment settled. 25,000 accounts, 4 million in aggregate missed tax benefits, 9 million settlement, 4 million returned to clients through a fair fund. The median payout was roughly 100. 3 years of paying fees for a service that was not running. A client with 300,000 attempted to add an external account for a transfer. The account was immediately frozen. Identification was submitted the same day. The company's policy states 3 business days for review. The account remained frozen for 3 months. A separate client deposited 600,000 and requested withdrawal, 5 days on hold. Another client requested a partial transfer that exceeded 90% of the account value. The system automatically liquidated the entire portfolio, not just the requested amount. The policy is designed to avoid small residual accounts. The consequence is unexpected capital gains taxes on positions the client did not intend to sell. The policy is not prominently disclosed. 2 class actions were filed in 2026 over a data breach through a third-party dashboard tool, but the numbers and the competitive landscape determine whether the fee is justified at all. A traditional brokerage offers a free robo-advisor for accounts under 25,000. Another offers one free under 5,000. A third charges roughly a fifth of 1%. The company charges a quarter of 1%. On a 100,000 portfolio, that is 250 a year. On 500,000, it is 1,250. A human financial advisor typically charges 1%. The fee is genuinely lower than human advice. The question is whether it is low enough to justify paying anything when free alternatives exist from institutions with decades more experience in custody and clearing. The cash product pays 3.25% with insurance coverage up to $2 million through a network of partner banks. In the current interest rate environment, this is competitive and generates meaningful revenue for the company. The cash product alone may justify maintaining an account, even if the investment product faces pressure from free competitors. The more, tax loss harvesting system is confirmed functional since the 2019 correction. The regulator's settlement included enhanced compliance requirements for monitoring and verifying that automated services perform as disclosed. For accounts under 24,000 without recurring deposits of at least 200 a month, the company charges 5 a month flat instead of the percentage fee. On a 1,000 balance, that is 6% a year. On a 5,000 balance, it is over 1%. The flat fee makes the product uncompetitive for small balances without recurring deposits. The fee structure creates an implicit minimum that the marketing does not emphasize. The company serves over 1 million clients with over 45 billion in assets. The venture capital valuation peaked at 6.25 billion. Whether it justifies its fee depends on whether the tax loss harvesting and automated rebalancing deliver enough value above what the free alternatives provide. Betterment is the most appropriate independent robo-advisor for the hands-off investor with 25,000 to 500,000, who wants completely automated, tax-efficient investing in low-cost index funds and is comfortable paying 0.25% for that automation. 18 years of operation, over 45 billion in assets, over 1 million clients, profitable from 2024. The tax loss harvesting is confirmed working since the 2019 correction. The cash product is competitive in the current rate environment. The portfolio construction is sound. Free transfers out with no exit penalty. But the regulator documented a 3-year period where the core technology that justifies the fee was not working for 25,000 clients while they paid for it. The median payout was roughly 100. The 90% liquidation policy is not prominently disclosed and creates substantial tax risk for clients who want to transfer most of their assets. A 300,000 account was frozen for 3 months on an identification review that should have taken 3 days. 2 class actions over a data breach through a third-party tool are ongoing. The flat fee for small balances makes the product uncompetitive below 24,000 without recurring deposits. Before opening an account, confirm tax loss harvesting is active. Know the 90% rule before any large transfer. Set up identification verification proactively. Compare the fee against the free alternatives at traditional brokerages. The algorithm was built to do what human advisors could not. For 3 years, it did not do what it promised. It is confirmed working now. Verify it yourself. The promise is automation. The lesson is that automation requires verification. Every choice is a trade-off. At least now you know what you're trading.